Hello everyone, Kasim Khan is here. Please subscribe my channel and press bell button for more updates. So guys, thank you so much for watching my video, and today we are going to learn the concept of valuation of long-term securities, and in this we will discuss in detail about the stock valuation, and the outline of today's lecture is preferred stock valuation. We will also learn about the common stock valuation, and we will discuss about the different dividend growth pattern assumption like constant growth model, no growth model, and growth phases. So, to read out this kind of content, you can consult the book of Van Horn, that is Fundamental of Financial Management, 13th edition, chapter 4. And you can also read the book of Brigham, that is Fundamental of Financial Management, 13th edition, in chapter 7. So, what is preferred stock valuation and what is preferred stock? Preferred stock is basically a hybrid kind of security because it carry the characteristic of both debt and equity security, and this is that's why it is known as the hybrid security. And it is a type of stock that promises a usually fixed dividend but at the discretion of the board of directors. Most of the time, the dividends are the fixed and paid at the promised date and after a fixed time period. But the decision of issuing the dividend is mostly depends on the decision and discretion of board of directors, because sometimes organizations are facing the financial problem and they can delay the dividend. And why the preferred stock is a hybrid kind of security, because dividend is the characteristic of equity security, and this security carry this characteristic, and fixed payments, and the fixed is the characteristic of the debt security, and this characteristic is also involved in the preferred stock. So that's why preferred stock is also known as the hybrid security, because it carry the characteristic of both debt security and the equity security. So the preferred stock has preference over the common stock in the payment of dividends and claims on the assets. So here is the valuation method and the process of the preferred stock. And one thing more about the preferred stock valuation is similar to the perpetual bond valuation, because the maturity of the preferred stock is also not stated and declared. So that's why the preferred stock valuation is similar to the perpetual bond, and it is not surprise because the maturity time period is not declared and stated in the preferred stock valuation. So here is the V is the value of the stock. Preferred stock is equal to dividend. DIV is representing dividend, and P is representing the preferred stock. A dividend of preferred stock divided by 1 plus KP is the discount rate. K power 1 is the first representing first year, plus dividend in dividend P divided by 1 plus KP. K power 2 is representing the second year, so on. DIV into P divided by 1 plus KP. K power infinity. Infinity is representing the endless time period. So when we summarize and simplify this equation, here we get summation infinity into t is equal to 1 dividend into p divided by 1 plus kp power t. So when we again simplify, and we can reduce to into perpetuity, that is v is equal to dividend div p divided by kp. So this is the most simple form of this equation. And if you remember that in the time of perpetual bond, here we represent I because representing the interest payments, and in the bond we use the interest payment. But when we talk about the stocks and this, when we talk about the equity securities and the stock, here we take the dividend. So that's why V is equal to div into p divided by kp. So we can find out this value also from the tabular values. So if we calculate with the tabular formula, then we will use this equation: div into p, dividend of the preferred stock, multiplied by into present value of future dividend streams, PVIFA, present value of future dividend stream into KP. KP is the discount rate, and here is the infinity. So here is the problem explanation to uh, here is the problem explanation for this concept. Stock PS has an 8% $100 par value issue outstanding. The appropriate discount rate is 10%. What is the value of the preferred stock? So here is the dividend. How we can find the first year dividend? 100 multiplied by 8%, that is $8 is the first year dividend payment. So KP is the discount rate, that is 10%. When we will write here the formula V is equal to dividend into P divided by KP. First year dividend is $8, which we have find out in the like previous equation. So $8 divided by 10%. So $80 is the value of this stock, and $80 is the present value of the stock, which has a par value $100. So common stock valuation. Common stock represents a residual ownership position in the corporation, and this is the full equity form security, a pro rata share of future earnings after all other obligations of the firm, if any remain. Dividend may be paid out of the pro rata shares of earning. So pro rata is basically the kind of average calculation of shares for shares and the share dividend payments for the shareholder and the owner of the company. So, what cash flows will a shareholder receive when owning shares of the common stock? So, how we estimate the future dividend in the common stock, and what will be the price when we sell out the share, common share? So, this is the question, how we can find out the calculation and the valuation of future dividends. So here is the future dividend, future sale of the common stock shares. So the for the valuation of these two like factors and the concept, we use different dividend growth pattern assumption. So there is not any kind of single assumption for the calculation of future dividend streams. We can use multiple models and the different growth models of dividend for the calculations of future dividend. So the dividend valuation model requires the forecast of all future dividends. The following dividend growth rate assumption simplify the valuation process. The first one is constant growth model. The second one, if there is no growth in the dividend, how we can estimate the future dividend, and if uh, the dividend follow the different growth patterns, then how we can calculate the future dividend streams. So first we assume and that constant growth model. The constant growth model assumes that the dividend will grow forever at the rate G. So V is equal to D naught into 1 plus G divided by 1 plus KE. D naught is the current dividend which we are getting. 1 plus G. G is the growth rate at which dividend will grow. 1 plus KE is the required rate of return of investor. This is the rate the investor are expecting and required from the organization. One is the for the time period and for first year. Same like as the D naught into 1 plus G to power 2, 1 plus K e to power 2 for the second year, so on. So at the end of time period and the maturity, D naught into 1 plus G to power infinity divided by 1 plus K e to power infinity. So when we will simplify it, so D naught into 1 plus D, this will be converted into D1. D1 is the dividend paid at the time 2. So this will convert into D2, so on, D3, D4, so on. So divided by KE minus GKE is the required rate of return, and minus G is the growth rate. So this is basically the growth of this is formula is for the constant growth model. So here is the problem for the illustration and the explanation of this concept. Suppose stock CG has an expected growth rate of 8%. So each share of stock just received an annual $3.24 dividend per share. 3.24 is our D naught. D naught is dividend, current dividend, that is 3.24, and 8% is our expected growth at which this dividend will grow. So the appropriate discount rate KE is our 15%. So what is the value of common stock? So after getting some information from this statement, so D naught is 3.24 and this dividend will grow at the G. So because we are using constant growth models, D1 is equal to D naught into 1 plus G to power N. So 3.24 plus into 1 plus G 0.08 to power 1. So after the end of 1 year, this dividend will be grow and the value of this dividend will be 3.50. This will be grow from 3.24 to 3.50. Same like is that if we are interested to calculate for the second year, then we will multiply 3.24 into 1 plus 0.08 to power 2. And similar, if we are interested to find for D3, 3.24 into 1 plus 0.08 की power 3. So this way we calculate the D1, D2, D3, and when we will put these values in the formula, VCG is equal to D naught divided by KE minus G, and first D1 is 3.50 divided by 0.15 minus 0.08. So the value of this security and this common stock will be $50. If let's suppose if you are interested to invest in this security, then you need to pay $50 for this security. So the second one is zero growth model. Here we are assuming that the dividends are not growing over the time period, and when the growth rate in the dividend is zero, what will be the value of the S security and the common stock? So the zero growth model assumes that the dividend will grow forever at the rate G is equal to 0. So V Z G divided is equal to D1 into 1 plus K e to power 1 plus D2 divided by 1 plus K e to power 2, so on D infinity divided by 1 plus K e to power infinity. So D1 is representing the dividend paid at time 1. So KE is the investor required rate of return. This is the simple form of this equation because we are assuming that G is equal to 0, growth is 0. So that's where the simplify and the simple form of this equation is D1 divided by KE. So suppose stock ZG has an expected growth rate of 0%. If the growth rate is 0%, each share of stock just received an annual 3.24 dividend per share, same amount, same dividend we are getting per year, that is 3.24. The appropriate discount rate is 15%. So what is the value of the common stock? Same values, same information as presented in the previous slide. So the only difference is that in the previous problem, the growth rate was 8%, but in this problem, the growth rate is 0%. So what will be the security value of the common stock when the growth rate is 0? So D1 is equal to 3.24 into 1 plus G is equal to 0 because dividend is not growing over the time period. So this will be the same 3.24 is same like that for D2 is 3.24, D3, D4, D5, all dividend will be the same and that will be 3.24. So V is, ZG is equal to D1 into KE minus 0, 0 because G is 0. So 3.24 divided by 0.015 minus 0 and this the value of this common stock is $21.60. So maybe you have maybe you have seen one thing here, and that is the value of this stock is less as comparative to the previous one. If we see the previous one, if we see the previous one, in that the value was $50. The reason was that because this in this security the dividend are growing at the some constant rate, but in zero growth model, dividend are not growing, and you are just getting the same dividend. So that's why the security is cheaper, and this is available at $21. So when the security is when someone when any security dividend is growing in some positive rate, at that time that security is expensive in the market. So the last one is the growth phase model, and In this model, when there are the two different growth rate has been followed for the security, how it impact the total value of your security. Suppose the growth phases model assume that dividend for each share will grow at two or more different growth rates. So when your dividend is growing to different growth rates, and then how you value the security and how you calculate the present value of your present value of the common stock. So note that the second phase of the growth phases model assume that dividend will grow at a constant rate G2. In this one assumption is that first you will assume that G1, but in second phase G2 will be the fix over the which over the time period. It will not change. So here is the example. Company ABC has an expected growth rate of 10% for the first 5 years. Company ABC has an expected growth rate of 10% for the first 5 years. The dividend will grow at 10% for first 5 years and 6% after the 5 years. So each share of stock just received an annual $2 dividend per share, and the dividend of our security will be the $2 over the time period. So the appropriate discount rate basically KE, and this is also known as the required rate is 14%. So what is the value of the common stock under this scenario? Here we got some information. The first one is that for the first 5 years, the growth rate is 10%, and after that 6% forever, and $2 is our dividend, and 14% is our KE. So here in this question, basically there are two different growth rates. So how we use when there are two different growth rates? So here is simply for the first 5 years, we will calculate the dividend at 10%, and after 5 years, for the 6 years, 6 years onward, we will calculate the dividend at 6%. So what is the formula of the dividend calculation? Basically, D1 is equal to D naught into 1 plus 1 plus G की power 1 divided by 1 plus G की power 1. So here are the values. D naught is our $2, 2.20, sorry, $2 multiplied by 1.10. 1 plus G is 10% की power 1 divided by 1.14. Sorry, our 1 plus G is equal to, that is basically growth rate, KE is equal to 1.14. So when I will simplify this, I will get the value that is 1.93. 1.93 will be my value. So this way I can calculate the D1 dividend in the first year. So here is 2 is my dividend into 1 plus 10 is the growth rate, that is 1, that is equal to 2.20. Same like that, 2 into 1 for the second year, 2 into 1.10 to power 2, that is 2.42. And for the third year we will take the power 3, and for the fourth year we take power 4, and for the last year, fifth year, we will take power 5. So that is 3.22. This will be the last dividend of the fifth year. So but because the growth formula is that 2.2 divided by 1 plus g, that is 1.14 ki power this, and when we will divide this, we will get 1.93, 1.86, 1. Over the time period. So we can also find, if you don't divide 1 plus KE, then you can also find these kind of values from the table. And let's suppose if I am interested to see these directly values from the table, here is my 14% is my discount rate. And for the discount rate 14%, here is 14%. And if I see 14% for the first year, that is 0.877, 0.877 for the second year, 0.7 for the second year, 0.769, 0.769 for the third year, 0.675, 0.675, so on. I can also see that the present value of future streams from the table as well. So when I will multiply the present value of the dividend 2.2 multiply by this, so this will be convert when I multiply the dividend with the this present value factor, then I will get the present value of the dividend that will be 1.93. So after 5 years, the total value of the dividend for the 5 year will be the $8.9. So now the after 5 year, the dividend will grow at the 6%. In the first 5 year, it will grow at 10%. So dividend at the end of 6 year will be the last dividend is 3.22 multiplied by 1.06. When I will multiply with this growth rate, then I will get 3.41. This will be the dividend at the end of 6 year. So 3.41 divided by KE minus G, that is 0.014 minus 0.06. When I will minus this, then I will totally get 42.63. So when I will 42.63, simply I will multiply this value with the present value factor. And if I will see the present value, 14% at the end of uh, 6 years, that is 0.519, that is 0.519. And when I will multiply by this, then I will get the 22.13. So this is the present value of the stock at the end of 6 years. Then I will find out the total value, that is 8.99 plus 22.13. So the total value of this, the current value of this stock is $31.12. If I am interested to invest in this security, then I need to pay 31.12. So with this process, I can like calculate the value of a security which is which dividend is growing on to different growth rate. So guys, it was all about the preferred stock valuation, common stock valuation, and how we use different dividend growth model. That was zero growth model, constant growth model, phases, growth phases model. So it was all about the stock valuation. So guys, thank you so much for watching my video. If you are interested to know more about the concept of yield to maturity for the long-term security, so see you need to see my next lectures. So thank you so much.